Olivia pays the minimum on her student loans and invests the difference. Ethan pays his student loans off aggressively and invests after. They both think they made the smarter move. They're both wrong, because one of them forgot that compounding starts the day you contribute, and the other forgot that interest doesn't always behave the way the math says. And when you actually run the numbers over 20 years, the gap can be over $50,000 in some scenarios, and over $180,000 in others. Let's keep this fair. Olivia and Ethan are both 24 years old. Both just graduated. Both have $50,000 in federal student loans at a 6% interest rate. Both earn $55,000 a year out of college. The only difference is what they do with $500 a month of extra cash flow available after minimum payments. Olivia pays the minimum on her student loans, which is approximately $556 a month on a standard 10-year repayment plan. She invests her extra $500 a month into a low-cost S&P 500 index fund, starting at age 24. She'll be paying loans for 10 years while her investments compound. Ethan also makes the minimum $556 payment, but adds his extra $500 a month directly to the principal. He aggressively kills the loan. With $1,056 a month going toward the debt, he pays it off in approximately 5 years and 3 months. He then takes the freed up $1,056 and invests all of it. On day one, Olivia has $500 going into the stock market while still owing $50,000. Ethan has zero invested but is rapidly shrinking his debt. Their parents tell them both they're doing it right. Their parents are also probably contradicting each other, depending on which parent. Let's run the math through year 5. Olivia has invested $30,000 over 5 years. At 10% average annual return, her portfolio is worth approximately $38,700. Her loan balance has dropped from $50,000 to about $32,000 with minimum payments. Net wealth: $38,700 minus $32,000 equals $6,700 positive. Ethan has paid off his student loans completely. He owes nothing. He hasn't invested anything yet. He's just starting his investment journey at month 63. Net wealth: 0. At year 5, Olivia is $6,700 ahead. Ethan is debt-free, but starting investment compounding 5 years late. The flip already happened. He just doesn't see it yet. Here's what nobody tells you about the payoff debt-first argument. The math is heavily dependent on the interest rate gap between your debt and your expected investment returns. At 6% student loan interest and 10% expected stock returns, you're giving up 4% per year for the certainty of debt-free. Multiply 4% over the loan term and you're potentially leaving tens of thousands on the table. At 8% student loan interest, the gap shrinks to 2%. The math gets closer to a coin flip. At 10% student loan interest, which existed in past decades and could exist again, paying off loans first becomes mathematically obvious. The interest you're saving equals or exceeds the returns you'd earn investing. The federal student loan interest is also tax-deductible up to $2,500 per year if you earn under certain thresholds. That effectively lowers the cost of carrying the loan by 0.5% to 1% for most people. So a 6% loan acts more like a 5% loan after the deduction. Capital gains on long-term investments are taxed at 0, 15, or 20% depending on income. For most investors over a long time horizon, the after-tax return on stocks is closer to 8 to 8.5% than 10. That tightens the gap. By year 10, Olivia's loan is finally paid off through 10 years of minimum payments. She continues investing her $500 a month plus the freed up $556 from the minimum payment. Her total, invested over 10 years, $60,000. Portfolio value at 10% returns, approximately $96,000. Ethan has been investing $1,056 a month for the last 4 years and 9 months. Total invested, roughly $60,200. Portfolio value, approximately $79,000. Ethan is now catching up faster because he's contributing more each month. But Olivia's earlier dollars compounded longer, so she's still ahead. By year 15, the picture is more clear. Olivia has been investing for 15 years. Her contributions grew from $500 a month to $1,056 a month after year 10. Total invested, approximately $123,300. Portfolio value, approximately $235,000. Ethan has been investing for 9 years and 9 months. Total invested, approximately $123,800. Portfolio value, approximately $208,000. Ethan is still behind despite having contributed nearly the same total amount because his money had less time to compound. If I only showed you the math, I'd be missing the part that matters most for many people. Aggressively paying off debt has real, non-financial advantages. Psychological burden is real. Carrying $50,000 in debt for 10 years weighs on people in ways spreadsheets can't measure. Studies on financial anxiety consistently show that debt creates measurable stress responses, sleep quality, decision-making, relationship tension. If you're someone for whom debt creates real psychological burden, the value of debt-free is higher than the spreadsheet shows. Cash flow flexibility is real. If you lose your job, having no debt means your fixed monthly expenses are dramatically lower. You can absorb income disruption more easily. If you have $50,000 in investments but still owe $30,000 in student loans, a job loss creates a forced decision. Do you raid your investments to pay debt or risk default? Career flexibility is real. Debt anchors career choices. Olivia might feel obligated to stay in a high-paying job she dislikes because the loan payment is non-negotiable. Ethan, debt-free at 29, has more flexibility to take a pay cut for a passion project, start a business, or take a sabbatical. Risk concentration is real. Investing in the stock market while carrying debt means you're effectively borrowed to invest. If the market crashes 30%, which has happened twice in the last 25 years, Olivia's portfolio drops while her loans still need to be paid. Leveraged investing amplifies downside risk. And finally, behavioral consistency is real. Some people pay off the debt aggressively, because if they didn't, they'd spend the money instead of investing it. The Ethan strategy is only mathematically inferior if you actually invest the difference once the debt is gone. Many people don't. Paying off debt aggressively is the smarter move if your interest rate is above 8%. If you have any consumer debt credit cards, personal loans at higher rates, kill those first. If you carry significant psychological weight from debt, if you're in an unstable career or income situation where debt creates real cash flow risk, if you're behaviorally inconsistent and would spend the difference rather than invest it. Investing the difference is the smarter move if your interest rate is below 7%. If you have stable employment and emergency reserves. If you're disciplined enough to invest the difference automatically. If you have decades of compounding ahead of you and can absorb the time in market advantage. Year 20 final comparison. Olivia has been investing for 20 years. Her contributions grew to $1,056 a month after year 10. Total invested, approximately $186,600. Portfolio value at 10% returns, approximately $497,000. Ethan at year 20 has been investing for 14 years and 9 months. Total invested, approximately $187,200. Portfolio value, approximately $443,000. Olivia wins by approximately $54,000 in this specific scenario. The gap would widen further over years 25, 30, and 35 because the 5-year head start compounds increasingly. Now factor in the interest Olivia paid on her loan. Over 10 years of minimum payments, she paid approximately $16,600 in interest. So her true net advantage over Ethan, $54,000 minus $16,600 equals $37,400. Over 20 years, the real trap isn't paying debt early or investing first. The real trap is making the decision without running the numbers for your specific interest rate, your specific income stability, and your honest behavioral patterns. Olivia optimized for time and market. Ethan optimized for psychological clarity. The right answer depends on which factor matters more in your life. And if you're wondering what happens when you split the difference pay extra on debt for the first few years to reduce the principal, then redirect to investing. That's the strategy most disciplined financial planners actually recommend. But that's a completely different conversation. For now, the next time someone tells you to always pay debt off first, or always invest first, ask them one question. What's the interest rate on the debt, and what do you expect the market to return? Because the answer that includes both rates is the only answer that matters.